Greetings everyone, I hope you are all well. In this video we're going to be talking about Labour's hit list of taxes. Labour is considering significant tax increases despite ruling out raises to income tax, national insurance and VAT during the general election. Regardless of the pre-election promises and lies, this insidious administration fundamentally executed a plan of misinformation on the British public. If we're going to discuss false information, I put it to you that every word in the Labour manifesto was a lie, with the exception of thank you. And that was about as sincere and as asylum application from a 14-year-old at Dover. This loose collection of morally, emotionally and politically deranged impostors have already tied themselves up in knots, with promises they cannot keep, expenses they cannot pay, and commitments that will leave them no option but to rob Peter to pay Paul. The names of the beneficiaries are somewhat different, but I will leave it to you to work that one out, as we no longer have free speech. Here are some of the reckless routes to rob the British public that are under consideration. Proposed changes to inheritance tax. Reducing the nil rate band, yes, reducing from 325,000 to 125,000. Imposing tax on lifetime gifts above £3,000 per year. Taxing unused pensions and savings upon death. And here's the bad one, potential double taxation with inheritance and capital gains tax on estates, i.e. if you have assets or additional properties that are liable to capital gains tax on your death, they're proposing that they come at you for whatever capital gains tax would be payable if they were sold, then they will go for death tax. How will they calculate the death tax? On the pre-capital gains tax figure or not? I know it sounds like a ridiculous question, but anything is possible with these people. Increasing to 53% the tax on buy-to-let property or second homes, that's capital gains tax, and increasing the capital gains tax to 37% on sales of shares. Other potential tax changes include increasing the basic rate of dividend tax from 8.75 to 20%, cutting business and agricultural property reliefs. Another nasty one, imposing national insurance on rental income for buy-to-let landlords. Now, many buy-to-let landlords are already struggling because there are many, even now, landlords who are tied into a situation where they're paying tax on a rent because they're high earners and they can't claim the interest off of their outgoings or against their income. They maybe have tenants that they can't get out the property, and add to this national insurance on the rent. And will that be on the total gross rent received? More than likely, that is going to be a really, really nasty one. Changes to pensions. Potential reduction of the 25% tax-free lump sum cap from £270,000 to £100,000 or lower. Vehicle-related changes. The removal of 5% discount on fuel for petrol and diesel cars, and the introduction of pay per mile road tax for electric vehicles. Now, those of us who have conducted our research will know that there is absolutely no way that our infrastructure could support a nation of EVs. Not now, not for many, many years. Therefore, I put it to you that EVs never were, and never will be, certainly not in the foreseeable future, a viable alternative to ICEs. But what they are doing is facilitating the writing off and removal of ICEs from the roads. Indeed, I have it on good authority that insurance companies are now writing off ICEs much easier than before. They're taking our vehicles away from us. They write them off, they sell them off to Ukraine or wherever they go. And when this infrastructure falls down, one day we may wake up and to the news that a major charging station infrastructure has gone down, the company's gone down, whatever the case may be. As you know, VW, since the catastrophe on board a ship where one of their vehicles caught fire and sunk the whole ship with 4,000 vehicles, things have been going from bad to worse for them with regards to EVs. They've scrapped many of their EV proposals, but all of this expense has left VW one of the most indebted companies in the world, with debts in excess of 97 billion. Ford has just announced shelving one of its EVs, which has shocked the industry because it is considered to be one of their best sellers, certainly in ICE form. Mercedes has literally made plans to introduce more ICEs, and they have had considerable problems with their EVs. In fact, the EQE is rated as one of the vehicles that has the highest depreciation of all, losing around 50% in its first year. The list is just endless. But effectively, I put it to you again, this is simply misdirection to take our vehicles away from us. And I have no doubt that at some point the national infrastructure will collapse, and what will happen is there will simply be some self-righteous EV drivers within London where they belong, full of themselves and probably of the opinion that anybody who doesn't drive an EV is because they are poorly educated, a little bit like Remainers. Other considerations: potential capital gains tax on assets for those leaving the country. Canada has been doing this for a while now, and two-tier care is rumoured to have been picking Justin Trudeau's brains about this. Under this plan, those wishing to close their HMRC accounts and leave the country will have any assets that are liable for capital gains tax taxed at the current rate as though they had been sold, and this would need to be paid before leaving or before your HMRC account is closed. So professional advice and planning is highly recommended here, because that, to my mind, is one that is too tempting for them to resist. Cuts to pensioners' winter fuel allowance, which, as you know, has already happened. Proposals to axe free bus passes for the elderly. The likely removal of single persons council tax discount. Add to that the fact that they may restructure or raise council tax to force people living in larger homes, or people who've been living in a home for many years with spare bedrooms, to find their home unaffordable because they just can't afford to pay the council tax, so that they sell, lose their home, and then that home can go to certain minorities who won't really be affected by the council tax, because more than likely they'll be on benefits courtesy of your taxes, so it won't really matter to them. The next one is VAT on independent schools, which, as you are aware, is on course to happen, and this will clearly result in a net loss in total revenue. It will have a devastating effect on the industry, as tens or even hundreds of thousands of extra pupils will need to be educated in state schools. For every child who leaves an independent school, the loss in VAT added to the additional cost for them to enter a state school will result in a net loss to the government of over £10,000 per year per child that they have not budgeted for. This is not economics. This is deranged Kieronomics. So all in all, the concerns raised through all of this that this is described as nationalisation of wealth. Where have we seen this before? Was it 1917 Russia maybe? Potential negative impact on savings, investments and business startups. Reports, unconfirmed so far, of up to 1.9 million heirs leaving the country. As far as implementation timeline, this won't all happen in one go, but most of these harebrained proposals are expected to be implemented during the course of this Parliament, if they last that long. That's all for now. Thank you very much. Bye bye and see you next time.